Freeman Linde, welcome to the show. How are you today?
Good, Joe. Happy to be here. Excited to chat with you today. And we've been going back and forth a little bit. Sounds like we're really aligned on a lot of things, so it should be a good conversation.
Yeah, well, I'm excited to have you on because sometimes in this space, as you know, you can feel like you're in a little bit of a bubble, I guess you could say, right? There's a lot of different financial planners out there, but not all of them share a similar philosophy and are trying to do planning the way you and I are. So when you kind of run across someone else with a similar philosophy, doing planning the same way, and a similar focus, it's just nice to have a conversation.
Yep.
So
I always like to tell people people like you and I that planners who do it right. We're rare, right? There's a lot more of other people out there, but we're not unique, right? I'm not the only person doing it this way. There's a lot of really good planners out there doing it the right way, and we're all happy to support each other because we know we can't possibly work with everyone ourselves, and so it's good to build that network of people doing it the right way.
yeah, absolutely. And it's another reason why we do the podcast too, right? It's just we can't work with everybody, but it's a good way to get good information out to some other people we'll never probably meet.
Yep.
So for today, the topic we have is the Four Horsemen. So you're going to talk to us about what the Four Horsemen are. So from a high level, the behavioral mistakes that destroy our investments is really the topic. So maybe Freeman will just dive in. So the first horseman, chasing returns. Tell us about the first horseman.
Yeah, and so really what this is we've looked at, a lot of times when we're talking about investing, we're always talking about returns, right? And like, yeah, what kind of returns are we getting in each year or each quarter or heaven forbid every day, or like over a long period of time, hey, what are the returns that the markets are getting and all that? And I think a lot of times we fail to recognize that the returns that investors get are often quite a bit different than the returns that investments get. So it's easy to track, right? Like what does the S&P 500 do, or the Dow Jones, or certain other indices. You can go back and say like, hey, what have these stocks done over this period of time? And that's easy to find out. But some other companies have done this research that shows that the actual investors that invest in these funds don't do as well. And so there's one company in particular, Dalbar, that studies all kinds of metrics to kind of say, hey, what is the average investor actually getting when they invest in these returns? And so one of the studies that I use quite a bit show that from this 30-year period, right, the S&P 500 averaged 10%, right? It was up and down all over the place in the middle, but it averaged 10%. But that the average investor investing in the S&P 500 only averaged 5%. And so like that's a big difference, right? And you think, oh man, that means they got half as much money over that time, but that's not really how compounding works, as you know, right? So for example, like if you had $100,000 invested at the beginning of that period, at 5%, you would have grown 100% to $600,000, or maybe we're 6%, something in there, right? So you go from 100,000 to 600,000, which is pretty good, but at 10%, that same 100,000 would have grown to 2 million. Right. And so even though the markets grew to $2 million, the investor only grew to 600,000. So that's a big gap there. And so one of the things that we're seeing to do is like, hey, what explains this gap? Why are the returns that we're getting as investors so much worse than what the general market is doing? And so we kind of distilled these into yeah, right. We call the Four Horsemen and four different things that just destroy our returns. And the first one that you mentioned already is chasing returns. And the way that I like to think about this, and basically what it is it's always trying to be in a fund or an investment that's doing better. And so you're constantly moving your investments around, jumping from one fund to another, from one company to another, trying to get the best returns. And I think one good way to think about this is probably all of us, anyone listening to this has probably been stuck in traffic at one point or another, right? Like you're stuck in traffic on the 401, nothing's moving, it's kind of gridlocked. You're in the left lane. And then you start noticing that cars are starting to pass you on the right lane. You're like, what the heck? I'm trying to get there faster. And so you move from the left lane into the right lane so you can get there a little bit quicker. But you know that as soon as you do that, right, that lane's going to slow up and the lane you were just in starts taking off, right? I don't know if that's ever happened to you. It happens to me all the time. And you start tracking like, I'm just going to I started behind that bus. As long as I get ahead of that bus, then I'm good to go. And you keep moving back and forth. And eventually that bus is just way out there in front and you lost it. So you realize by the end, you would have gone further faster if you just stayed in one lane than constantly trying to jump lanes to try to, eke out a little bit more speed. And so I think in the same way, like we often we'll look at our investments, we'll look at what's happening there, and we'll say, hey, these other options I have, they seem to be doing better than the ones I'm in. And so you jump to those new investments only for them to slow down, and the ones you were just in to surge ahead. And so by constantly chasing returns, constantly trying to get the best return possible, you end up with less return overall for all your efforts and all your headaches. I don't know if you've seen that at all, Joe, or you've run across people that have done that, but it seems to be something that I see all the time.
Yeah, I mean, it's super common, especially when we go through periods like we just went through with 2022, right? It's a difficult year, no matter where you were, stocks or bonds, and people think that, yeah, we got to, okay, well, what is working? Something must be working. We should be jumping to that. And it kind of reminds me of, I can't remember who I heard this from, but they talk about soccer goalies for penalty kicks, right? And the stats actually show if the goalie just stood in the middle of the net, they would save a higher percentage of the penalty kicks than when they guess and they jump sideways, trying to see where they're going. But none of them ever do that because it looks like they're not trying, right?
Yeah.
What I find is, and a lot of a lot of our clients who are really successful, they're really hard workers, right? And when things got tough, they found a way to make more money, make things work by working harder. So it's just natural for people to think, well, when times are getting tough with their investments, we should be working harder. We should be doing something else to get us further ahead. But the problem is that's like the exact wrong thing to do in most cases. Yep. So yeah, no, it's something I definitely see all the time, especially when things are a little tougher than average.
Yep. And yeah, often the hardest thing to do is to do nothing. And that's often the very right thing that we should do. And that's tough to do. And so we feel better doing something, chasing something than sitting there and just staying the course, which is it's tough to do.
Yeah, definitely makes us feel good to take action for sure.
Yeah.
All right. So the second horseman is poor diversification.
Yep. So you probably, you've seen this, I'm sure. You have people coming over with either portfolios they've built, or maybe they're coming from another financial services representative or something. But you kind of see this in two different forms, right? We kind of think of this horseman is he's got, twin swords, and the first one is under diversification, right? Which is all your eggs in one basket. And maybe it's someone works for a company and they have a bunch of their company stock and it started small, but it's kind of grown to a big portion of their overall portfolio. Or maybe they kind of got lucky and they got in on Amazon or Apple early on, or some of these other companies, and it started off as a small portion, but now it's a big chunk of their portfolio, and they just can't see giving it up, right? It's done so well for me. It's kicked the pants off of anything else, and I want to keep it. Nick Murray, who's a legendary financial advisor in his own right, he's like 80 now, but he often says that diversification means that you never hold enough of anything to make a killing on it, but you also never hold enough of anything to be killed by it, right? And so that's often what will happen is we'll hold on to this great stock or this great fund or anything for a long time, and then eventually it falls off, or eventually it crashes, and we're still holding on to that when that happens. And so what we always got to ask ourselves is, if you have what we call in the industry, right, a highly concentrated position, like a whole bunch of your money in one fund or one company, just the question we always got to ask ourselves is, hey, if this went to zero, if this crashed, would we be okay, or would we still be able to reach all of our goals? And if the answer is, well, all of our goals would be ruined, our portfolio would be ruined, like we would be set back years and years, then you own too much of that one fund or that one stock, and it's time to spread that money out. And so that's the first form, and you've probably seen that quite a bit of people really just trying to hold on to one thing too much, and it doesn't, problem is like, you can say, well, this never happened before, it's always treated me good, I've never had a problem with it, and under diversification is not dangerous at all until it's outright lethal, and you'll know that happens, and it'll be too late at that point. And so we got to, as much as it might hurt, we got to be proactive with some of these things and spread that out. And all of us advisors, we're always championing diversification, so that's one that I think that we see quite a bit, and something we're always rapping on people to get diversified.
Yeah, and one of the things I always tell people, especially with like the company stock that's been building up over their career, is to just try to take an objective step back and think, if I didn't work for this company and I didn't have this stock right now, and I had, $1 million, would I take my money and put it into this company? Like, does that make sense when you kind of take it from that outside perspective, right? Because it's really hard when you've been working for a company, you've seen it do well. And I mean, there's research that shows, I think it's like 4% of the companies in the S&P 500 are responsible for like all of the returns above inflation. I can't remember what the time period is on that, but it's like a 50 or 100-year time period. So it's very unlikely that that company stock you own is going to be one of those four, part of that 4% in the long run for your retirement. So
Yep.
it's really important to make those decisions to diversify, but not always easy.
Right. Yep. So that's one of them. That's one that we kind of think of the most when we think of diversification. But there's also the other sword that this horseman wields is over diversification. And this is where you see, I'll see this a lot where someone will come in with a portfolio constructed by somebody and they've got like 40 different funds. Right. And it just seems like, oh yeah, I'm super diversified. I've got all these different funds and I've got a large cap and a growth and a blue chip fund and like all these things. But you look under the hood of all these different funds and the companies, the businesses that make up those funds are almost identical under the hood, under the surface, right? And so you'll look at, they've got 4 different funds and the top 5 holdings of all funds are exactly the same and make up most of those funds. And so we call it pseudo diversification, right? You feel like you're spread out, you feel like you've got a lot going because you got so many different funds, but really you're just invested in the same companies split up in a whole bunch of different ways. And I think what that does, well, A, it has no benefit other than, and B, it has a lot of cons, right? A lot of times it can increase fees because you're paying more for one fund with the same companies in it than you may be paying for another, identical companies, just a cheaper fee. So it's got a lot of fees, more redundancies. And then I think too, if we take a chapter from like the health and wellness field, like what is the best, if you're trying to lose weight or get healthy, like what's the best diet you can follow? Is it keto? Is it the Whole30? Is it, there's so many diets out there, right? And what people often say that no is, well, the best diet is the one you actually follow, right? And so, you have people that have had results with all these diets and people who haven't, and the real differentiator is, can you actually follow it? In the same way, like if we want really good returns investing for decades, right? Not just years, then we need to follow an investing plan for decades. And the easiest one to follow is going to be the one you actually understand. And so if you don't understand why you've got 40 different funds, you're probably not as likely to stay committed to that investment strategy as you are if you actually understand the strategy that you're in. And so we see that a lot with over diversification as well. And either one of those under or over can set you up to fail when it comes to the behavioral side of investing.
Yeah, I see that in Canada. I would say that's a really big issue. I see so many portfolios that have exactly what you're talking about. But the thing is, in Canada, we have a home bias. So we have a lot of Canadian, like a lot of these portfolios I see have a ton of Canadian funds. And the difference maybe between, at least in the US, I mean, there's so many different companies, a lot of them are, global. But in Canada, we have, basically 2 sectors. We have like energy and banking. So I could see a client or a potential client come in with a portfolio that has, just say it's 10 different funds, but they've got, the RBC Canadian Dividend Fund and the Scotia Dividend Fund, and then they have the Canadian Large Cap Fund, and then they have, all these different funds. So there's some over diversification in a sense that they have all these funds they don't need, but they're actually under diversified because they have a portfolio that's 80% Canadian, and we're about 3% of the total stock market by value.
Yep.
So it's this mirage of diversification when it's not even there at all.
Well, that's so interesting too, right? Because then you're actually getting killed by both swords at the same time. You're both over diversified and under diversified, which you wouldn't think would be possible, but there you go. So
yeah, exactly. And the other thing I see on that is sometimes when we have a globally diversified portfolio, so we look a lot like the index, really. And so sometimes we'll see clients are like, I don't know if I'm diversified enough. Like we only have like a few holdings here. Like I try to explain, well, there's about 12,000 different companies here. So we're very diversified, but we don't need to have 40 holdings to get diversified. But there's that feeling like maybe we should buy something else. And then all of a sudden, all we would be doing is creating that issue you just talked about, an over diversification. So
for sure.
All right. So the third horseman is market timing.
Yeah, so this one's a big one. This is attempting to be in the market only when it's going up and to be out of the market before it goes down, right? And this is something that, like, whenever you look at a stock market chart over a long period of time, right, on these indexes or whatever, like, it seems so like that it's possible. Like you see these big, upticks of it going up and then these catastrophic crashes, and you're like, man, shouldn't it be possible to kind of get in and then as it's gone up high enough to get out, go to cash and wait for the crash and then get back in at the bottom, sell high and buy low. And, and this is different than than trading, right? Like day trading or weekly trading where people are buying and selling different companies to try to take advantages of individual company, ups and downs. This is more trying to time whole market cycles, right? To be in during the bull markets and get out before a bear. And the problem with this is, and you probably talk to your clients about this, right? Like if you're trying to do that, you have to be right twice, right? When you get out and when you get back in. And so like we talked about this in the book, and I use some graphs in there of a couple of different case studies where, someone had been invested, they invested, were invested in 2009 during the big global pandemic or the big financial crisis, right? And it had come back up, and it was 2015. They're like, man, it's been going up for years now. It's at an all-time high. Like we've got this contentious US, 2016 election coming up. Like we don't know what's going to happen. I think that the market's going to crash, and so I'm going to get out. So he gets out of the market in 2015. The market, the election is contentious. It causes some volatility, but it doesn't quite crash. But he's determined to get in on a crash, and so he holds on and he holds on and he holds on, and then finally the COVID crash happens, right? Down whatever it was 35% in 33 days or whatever it was, right? And he gets in like right perfectly in the bottom of the COVID crash. And so he did it, right? He sold when the market was high, and he bought in when the market was low, and he like perfectly timed the market cycle, right? Except that the market had gone up so high between 2016 and 2020 that even when it crashed, it was still 56% higher than when he had got out in 2015. Right. And so even though he got in at the right time, he got out at the wrong time. Right. Or maybe you had someone that invested all the way through, and then just, in January of 2020, just like heard rumors of the COVID crash, like just thought like, oh man, this has got to upset things. And so he gets out, January of 2020, and then the market crashes, and he's like, perfect. I perfectly timed this, like got out at the peak. And then the market went down. He's feeling good about himself, but then it starts coming up. And it's coming up, and it passes this all-time high, and he's like, oh man, like this is weird, like this shouldn't be happening, like I don't want to get back in right now because it's still scary, and I've heard it's gonna be a W recovery, right? And it's gonna go back down, so I'll just wait for the other shoe to drop, and I'll wait for that second crash, and then I'll get back in, and it never happens, right? And I wrote the book in spring of 2022, right after the market kind of peaked at the end of 2021 there, and so, the market at that point had just continued to go up. And obviously we know 2022, it kind of came back down a little bit. But even then, at its lowest point in 2022, it hadn't come back down to that peak before the COVID crash. And so people who did that are still waiting to get back in. And the market's up substantially from that point. And so if you miss either of those, getting in or getting out, like you can leave tons and tons of return on the table, and it could cost you, tens, if not hundreds of thousands of dollars. And so for most people, you're better off just staying invested, weathering the storms, and not trying to time out those cycles.
Yeah, that decision about getting back in is probably the hardest decision, because I mean, if you think back to 2020, when the market's down 35%, when it started coming back up, there wasn't not a whole lot had changed, right? There's some we know there's some government funding coming in, but there's still lockdown, especially in Canada. We were like right lockdown, and there's no vaccine yet. There was no talk about a vaccine, just that people are working on it. But I mean, I don't think an announcement came out from Pfizer till like November. But the market had recovered by May, so people are just sitting waiting. Well, no, it's still too uncertain. Like the market, can't come back because there's just too many unknowns. And like you say, well, I mean, we know what happened since then. So it is not an easy decision to make.
No, there's always gonna be another crisis looming, right? Always another thing. It's a catastrophe that's right around the corner that's gonna want us to not get back in. And so either we need to have that mental fortitude to stay invested through the ups and downs, or you're just never gonna want to get back in. And two, I think there's a quote by Peter Lynch, I think, who's a legendary investment advisor here in the U.S., who said that more money has been lost in preparing for or anticipating market corrections than has been lost in the corrections themselves. Right. Then more people have given up more of their lifetime savings, more of their retirement savings, just assuming that a crash is going to happen, or waiting for the other shoe to drop, or whatever else, than anyone has ever lost in the actual downturns themselves. So, the third horseman, man, especially over a few decades, like most people have been caught trying to do this at least once. And I feel like a lot of the clients that I've had or talked to that stopped doing this are the ones that tried it a few times, were wrong several times. They're like, you know what, whatever, I'll just let you, you tell me if I should get out or not. And I'll just do that. So.
Yeah, actually, one of the last clients that we just had in for a discovery meeting, they said, "Look, I'm here because I've tried too many times and it's not working."
Yep.
All right, so on to the fourth and final horseman, panic.
Yep. So this is the big one, right? And often panic is kind of preceded by its siren song, which is euphoria, right? Which is that we get excited about the market when we see it going up, right? And you get, maybe the decade of post financial crisis through up to COVID, and the market's just, I think it averaged like 17% a year for like a decade, right? Just kept going up and up and up, or maybe there's a new fad, that was .com back in the early 2000s, or Bitcoin or whatever it is, right? And you either want to get on the ground floor of something that's great, or the market's been going up for a long time, and so it's finally time to get in and get some of that return. And it's been summer for a really long time, and so people, some people that sit on the sidelines for most of their investing career will wait until the market's been doing really, really well before they'll finally get in and say, hey, I want a piece of this pie. And often that'll be right before the market then corrects, then goes down. And so, when that happens, right, you and I know that market corrections are as common as dirt, right? Happen, 4 out of 5, 1 out of 5 years on average. And so it's just part of, the volatility, the downturns. That's how we earn our superior returns over decades, right? And so we know this happens all the time, but it's different when it's your money and you see your life savings that you've worked decades to accumulate decreased by 20, 30, 40%, maybe even 50%. And for some people, it's just too much. And they think, hey, you know what? I got to stop the bleeding here. Better to have some and maintain some than to see it all go to zero. And so they panic, they pull out of the market when it's down, and they're still out when it comes back, right? And then at some point they gotta either hopefully wait that it comes back down again, or jump back in when it's much higher than when they got back out. And if you fall to this one, right, if you panic out when the market's low and you miss that recovery, there's no coming back from that, right? Like we're never gonna see 2008, 2009 global financial crisis lows ever again, right? We probably will never see COVID crash prices ever again, right? That ship has sailed. And so if you got out at the bottom of COVID, you may never recover from that. And so this one, especially, like, it probably happens the least often, but it's the most devastating when it happens. And so this is one that you got to avoid at all costs. And if you ever feel like, I got to pull my money out when the market's down, that's really when you got to talk to a planner, really when you got to make sure you're on a plan and listening to some other, unbiased outside advice that can keep you investing. Because if you get out, there's just no coming back from that.
Yeah, that's something. And you mentioned Nick Murray earlier. Nick Murray, talks about if your advisor can keep you from making that big mistake just one time, that will pay for all the fees you ever pay for the rest of your lifetime.
Yeah. Yep. Not to mention all the additional value that they're providing over that time as well. So, it's one of those things that, like, these other ones, they're going to chip away at your returns over time. And I don't really think, when it comes to chasing returns or over or under diversification or market timing, some of these things are what they can really just sort of reduce your returns over time. But if you panic out, that's just going to destroy it, right? And you think about it, like, you can invest perfectly for 29 out of 30 years. And you make this one mistake just once, and you can undo decades of progress. And so this one it absolutely must be avoided. And so that's part of a lot of what that we do. And I think probably advisors like, planners like you and some of the other community is a lot of what we do. Obviously, we have a lot of technical knowledge. We're helping on that. We're helping you optimize your portfolio, save taxes, prepare for retirement, all these other things. But a big part, I'm convinced, of our job is just helping you have a better perspective on what's really going on, right? Not succumbing to all the, if it bleeds, it leads, and all the scare and fear tactics of the media and all that, and just keeping you on course so that you never make this mistake.
Yeah, I couldn't agree with you more, Freeman. Well, listen, it's been a blast having you on here. I think our listeners are getting a lot of good information, and hopefully you can help them avoid the Four Horsemen in the future. But before I let you go, can you just tell our listeners a little bit about where they can find you, kind of what you've got going on?
Yeah, so my main kind of educational content is retirementorship.com. That's where I have my podcast is on there, some other resources that we use, and all that's just, again, focused on increasing your knowledge about finances, deepen your belief in financial planning and having a plan and sticking with it, and inspiring you to act on that plan and actually get done the things that you need to do. And so it's not boring market commentary. It's also not that technical, most of it. It's a lot more just behavioral or inspirational type content. And so that's kind of a lot of our focus on there. And so that's probably the best place to find me, retirementorship.com.
Perfect. And that's what I think our listeners are looking for. That's why they're on this podcast. So appreciate you sharing that. And again, appreciate you coming on here today, Freeman. Thank you.
Yeah, Joe, it was great talking to you. Thanks a lot.
Take care.